The pandemic. Now, the good news is deaths are abating, and they are allowing the dismantling of virus curves and the release of pent-up demand. Yet the pace and timing of reopening is different in each economy. And that brings us to China. So China has yet to abandon its zero COVID strategy, and that has two problems for ASEAN. It damps export prospects for direct trading partners, and also China's persistent lockdowns exacerbate supply bottlenecks. So the impact on inflation is mixed. Now, the third factor is the war in Ukraine. The resulting sanctions imposed on Russia have caused a commodity price shock, and that's making inflation higher and more persistent than otherwise, and so more of a hurdle for household spending. So this is going to accelerate the tightening of monetary policy in many cases. And the higher yield, slower growth environment will also add to debt stress. That is, if governments don't promptly restore fiscal discipline. A fourth factor out there in the world impacting all of us is Fed policy. The Federal Reserve has gotten behind the curve on inflation, and that is meaning more aggressive tightening than would have otherwise been the case. So this has two problems for Southeast Asia. One is the narrowing in the interest rate differential and the greater likelihood of a U.S. recession that will lure capital away from the region. Also, slower growth in the U.S. will dent export prospects. Lastly, and I've added this as a separate factor, of course, all of these four factors are influencing markets and putting them on a roller coaster, but I've included this as a fifth factor. This volatility is a dampening of appetite for risk or investment, and the losses sustained by investors add to the fragility of the post-pandemic recovery. So I'm going to go into each of these factors in a little bit more detail. So first, the pandemic. So the good news is the global weekly death toll is down to around 1,500. That's the lowest since March 2020. And despite the emergence of new variants, we're seeing this decline. So that means we're seeing the phasing out of these disruptive curves. And it's this reopening and unleashing of pent-up demand that is going to underpin growth in the region this year. So those countries that are actually having more reopening to do this year, they're going to experience a bigger bounce in domestic demand than those that started at the end of last year. But even so, there's going to be some residual effects from the pandemic once we've reopened. So we've got some behavioral shifts that may stick around, sort of these homebound behaviors we may stick to, or it might take a while to change. That is, of course, after the release of pent-up demand. We also have amassed debt burdens. Now that's both public and private that are going to need to be addressed. We have depleted savings cushions, which will need to be rebuilt. And of course, we have these supply bottlenecks, which will still need to clear. Back to China. Now, of course, not everyone is reopening. China has yet to abandon its zero COVID strategy, and they're still seeing significant risk to reopening from looser curves because of vaccine efficacy and take-up of vaccines. So its transition to living with COVID could take another year or even longer. The current slowdown from COVID lockdowns is dampening commodity prices, so that's a helpful aspect of this slowdown. This chart shows China's dominant presence in industrial metals, which is extreme in iron ore. Now, while China's demand shock is good for inflation, the supply disruptions from China's lockdowns are going to keep prices elevated. And altogether for the region, ASEAN is going to experience headwinds from the slower demand and from the higher prices. But the good news here, again, is as China reopens, we will see these headwinds start to turn into tailwinds, but that's probably not a story for this year. Now, turning to the war in Europe, this is not the first time the Russian Federation has moved in on its neighbors, but the impact is vastly different. And that's because of the degree of sanctions put on Russia. And it's not just the official sanctions, but self-sanctioning by companies and individuals. And of course, this is not without costs for the global economy. Russia is a net exporter of oil and natural gas, as well as grains and metals. Ukraine is also a key supplier of foodstuffs. And then we have the knock-on effects across the substitutes for all of these items, and then the spillover all the way up the production chain. So the higher costs for these essentials will be a drag on the pandemic recovery as households and businesses find themselves with less spending power. This is going to be more problematic in countries with a larger share of vulnerable low-income households. Now, while this hurts the commodity importers, it certainly benefits the commodity exporters, and we have both of these in ASEAN. So how long this situation persists remains uncertain, though public support for sanctions may dwindle as the price and the market shocks drag on and as winter approaches. Now, turning to the Fed. Now, in the United States, all eyes are on inflation and the Fed. Headline and core inflation are above 8% and 6% respectively, which is the highest in about 40 years. The Fed is working to get its credibility back, and it may have to force a recession, though, to get inflation under control. So some Fed speakers have hinted at such. Chairman Powell certainly wants to see a clear pattern of disinflation before stopping rate hikes. Bloomberg Economics, my colleagues here, expect the Fed to press on with rate hikes until the Fed funds rate gets to 375 basis points. And they see that in the second half of next year. So we have about 300 basis points of more tightening to go from the Federal Reserve. Bloomberg Economics expects hikes in 25 basis point increments once the neutral rate of 2.5% is reached. Now that's a sharp and swift narrowing in the interest rate differential favoring emerging markets. So unless your country's central bank is hiking more or less in lockstep with the Fed, that's a problem for capital flows. And I don't see that as a likely situation in Southeast Asia this year. That is, I don't see ASEAN central banks moving as dramatically as the Fed this year. So the fifth item, markets. Now, typically when stock markets are selling off, at least in the last couple of decades, treasury yields fall, providing a support for growth. But that's not happening now. Yields are moving higher because of inflation and the tightening by monetary authorities. So that means wealth effect headwinds to growth from both stocks and bonds. For Southeast Asia, this higher uncertainty also tamps capital inflows, and that's more of an issue for countries relying on inflows to finance a current account deficit. So what does all this mean for ASEAN more specifically? So I've kind of divided the region into leaders and laggards and looked at these factors. So likely leaders this year on growth are going to be the economies that still have more reopening still to do. That's Indonesia and the Philippines. The leaders in the region will also be those economies that are more domestic demand driven. So that means they'll be benefiting more from this the pandemic reopening. That again is Indonesia and Philippines. Those economies that are going to be leading on growth will be having less exposure to the global supply chain disruptions. Again, Indonesia, Philippines. Commodity exporters are going to be benefiting. That's Indonesia, Malaysia. And those experiencing lower inflation are going to be benefiting more. That's Indonesia and Malaysia. So this lower inflation means better purchasing power for consumers and then less immediate tightening pressure for the central bank. Now, the likely laggards in the region on growth are going to be those, of course, with less reopening left to do. That would be Singapore. Those that are more trade exposed, more exposed to the slowdown in global demand that we're seeing in the US and Europe and China, that's again Singapore. And those more reliant on Chinese tourists, and that's Thailand. So what does this exactly mean for numbers on growth? Our latest published forecasts factor in Putin's invasion of Ukraine, but not China's recent lockdowns. Even so, we don't expect ASEAN's recovery to be derailed, and that's because we're having simultaneous pandemic reopening, which is helping to cushion the blow. So prior to China's recent lockdowns, we expected ASEAN 6 growth to average about 5.1% this year, slightly less than our 5.3% projection in November. Now that assumes commodity prices would remain elevated through through the whole year to year end, and that China could deliver growth in the ballpark of 5%. But now we are expecting growth in China to expand by just 2% this year. So we're going to have to adjust our forecasts. But this ranking that I alluded to on the previous slide will stick. It looks intact. So we still see Singapore and Thailand as the more vulnerable or with the slower growth to China's prolonged lockdowns, and the Philippines and Indonesia having the stronger performance in the region this year. So I'm going to just leave you with my last slide, which are the median forecasts compiled by Bloomberg. This is for growth, inflation, and monetary policy. Generally, we're seeing expectations for growth slowing in the advanced economies. That was going to be happening with or without Putin's war or China's new lockdowns. That's just the being more ahead on the vaccinations and the reopening, which started last year. On inflation, this is seen as less of a problem in ASEAN countries this year. We have price controls in many countries, which help damp the price pressures, or administrative prices that help damp the price pressures. And also there's more economic slack in our region because of its later reopening. On monetary policy, those central banks with more slack and fragility in their economies are going to be able to normalize policy later or slower. In ASEAN, that's the Bank of Thailand. We don't expect any rate hikes by the central bank in Thailand until pre-pandemic output is restored this year, actually restored next year. So it'll be some time there. Now, the central banks in Singapore, Malaysia, and the Philippines have already started tightening monetary policy. This is as pre-pandemic levels of demand have been restored. Singapore and Malaysia started tightening when inflation was still relatively low, which is going to help anchor inflation expectations and avoid having to stomp on the brakes. The Philippine Central Bank started its rate hike, as you know, started its cycle last week, as you know, with inflation already well above target. So we're expecting the BSP to hike by 200 basis points in total, spread across 2022, 2023, and 2024. Now, Bank Indonesia, the last one, they meet actually later today. The central bank sounds inclined to wait a bit longer before beginning its liftoff. Pre-pandemic output recently was restored in the first quarter, as it was in the Philippines. And the currency is under increasing pressure, so certainly they could move. But the central bank is telling us they are focused on core inflation, which remains benign for now. So that is all I have time for today. I would just encourage you to reach out. We have much more depth and breadth at Bloomberg Economics. And if you have access to our terminal, I point you to the BECO page. But for now, I'm going to now turn it over to our first listed company today, Monde Nissin Corporation. And representing Monde Nissin, we'll have Jesse Teo, the Chief Finance Officer, and Mike Pasca, Corporate Business Development and Investor Relations Director. Please join us and welcome them to the stage. Thank you.
Good morning, everyone, and thank you for your interest in Monde Nissin. And I would also like to thank the Philippine Stock Exchange and Bloomberg for hosting this virtual investor event. So today, to begin the presentation, I would like to direct everyone's attention to our corporate aspiration statement. And then if we can move to the fourth slide, please. So, as a corporate aspiration, we aspire to improve the well-being of people and the planet and create sustainable solutions for food security. Understanding this will help you better understand how we got to where we are today, as well as our plans and strategies going forward. And we will discuss this as we move through the presentation. Next, I'd like to move on to the next slide and just give you a brief snapshot of Monde Nissin. So Monde Nissin consists of two businesses. The first is our meat alternatives business. This is based in the UK and it contains our Quorn and Cauldron brands. It generates around 21% of our revenue. The remaining 79% of our revenue comes from our APAC branded food and beverage business. And within this business, there's three major groups. In order of size, starting at the largest, we have noodles, followed by biscuits, and then others. And others would include a variety of distribution partnerships, as well as our bakery business. Now, I'd like to turn it over to Jesse now to talk more about our APAC business. Jesse?
Thank you, Mike, and good morning to everyone. Thank you for your interest in Monde Nissin. I'd like to start by talking about our APAC branded food and beverage business. This is our bigger segment, and then I'll hand it over later on to Mike to talk about our meat alternative business. Please move to slide 7, please. First of all, I'd like to spend some time talking about our noodles business. Our noodles business is 40% of the group, and within APAC, branded food and beverage is just above 50%. This is our most important business with our most iconic brand, Lucky Me. We have good shares, nearly 70% share in the latest reading from Nielsen. But we believe that we have opportunities to grow even further. You will see at the chart on the upper left-hand side that our servings per capita are significantly lower than a lot of countries which have comparable GDP per capita. So we do have opportunities to consume more. Moreover, during the pandemic, we experienced huge growth because instant noodles represented a very cheap alternative to consume in a very convenient way in your home during the pandemic. So the volume surged, and this number of 41 packs per capita was actually in the mid 30s and increased significantly during the pandemic, but it's continuing to increase because of, as Tamara mentioned earlier, the pent-up demand effect. It is encouragingly increasing both in volume and in value. With the impending high inflation, we believe that, based on historical data, that this will become even more important food item because it is very, very economical as a food item, especially to the lower social economic class in the Philippines. We aspire to make our noodles healthy, and to this end, we have a proprietary high-speed airflow technology. Think of this as a big air fryer, 50 meters long, where we make our noodles with 70%, that's 70% less palm oil. Palm oil is, for those tracking this commodity, is at an all-time high. It's very, very expensive these days and very volatile. And also, because of the way palm oil is harvested, is oftentimes associated with non-sustainable practices. We consume significantly less with this technology, and we have one line actually producing one SKU in the market already, and we plan to bring in more lines in the future. We also recently introduced a Milky Me variant for our instant noodles. This Milky Me variant is a premium but a value-added variant. It introduces the goodness of milk mixed with our favorite instant noodles to provide not only delicious but health to our consumers. Because of the work that we have done in brand building, we have been awarded by Kantar, a very reputable market measurements firm, as the most chosen consumer brand in the Philippines for the 6th consecutive years. Now, this is not just a random survey. It is based out of market metrics of household penetration, of which there are more than 20 million in the Philippines, and frequency of purchase. Our household penetration is north of 98%, 98.2%, and our frequency of purchase in a year is more than 31 times. That means we are bought more than 2.5 times a month by almost all of the 20 plus million households, translating to a consumer reach points of about 788 million. Roughly speaking, although this is an extrapolated number, this means the number of times Lucky Me is bought by Filipino consumers. We've also used the digital platform quite effectively in our advertising, in our brand building. You will see that we have been recently awarded by YouTube with the Best Collaboration Award. Is for the creativity and the business results from our recent campaign to promote our new Thin or a thin noodle dry pouch instant noodle.
Hindi ko nakikita yung ano.
Ibang katulad dun sa akin.
Hindi ko nakikita yung ano eh.
Next slide, please.
Yung speaker. No? Sorry.
Oo nga, sir, Dong.
Next slide. Okay, the next business category I'd like to talk about is biscuits. It's 25% of our business, and about 25 and about 30% of our APAC branded food and beverage business. We have a good share, and we're also in the number one position at 29.6%. It is not as dominant as our instant noodles. Biscuit is more fragmented. So this fact just means that we have more opportunities for growth, both on market growth and share growth. Now, the biscuit category has suffered a decline during the pandemic, especially in 20 and 21. Biscuits in the Philippines is mostly consumed out of home. Kids take it to them to school, and office workers bring them to work. With the stay-at-home environment of COVID, these usage occasions disappeared instantly, leading to a substantial decline of the biscuit category. But in 2021, late 2021 and early 2022 reflects a bounce back. As Tamara again pointed out, there's a lot of pent-up demand. The usage occasions are back. People are back going out, going to their offices. Some schools have started face-to-face sessions, and the usage occasions have increased significantly. With this, we are experiencing good growth in the first quarter, led by our most popular brands, Skyflakes and Fita in the cracker segment, and also on our other brands like Butter Coconut and Bingo. We plan to grow this by growing share and by offering other alternatives in order to help also spur the growth of the market. Next slide, please. Now I'd like to talk about the other portion of our APAC branded food and beverage business, starting with the culinary business. Culinary business is largely a collaboration with another company which owns the Mama Sita brand. The Mama Sita brand has among its portfolio of culinary aids, oyster sauce, where it is quite dominant at 60.7%. We have actually taken this brand from strength to strength with the start of our collaboration. We have an exclusive 20-year marketing and sales agreement with Mama Sita, and we have taken Mama Sita cumulatively almost have grown this business by more than 50% since we have taken over. We believe that Mama Sita has other products in its portfolio, just like its oyster sauce, that we can follow the playbook on the oyster sauce and grow to more culinary subcategories. We also have a very successful collaboration with Dutch Mill. Dutch Mill, incidentally, in the Kantar survey, also owns the number one brand in Thailand. So you have the number one brand in Thailand collaborating with the owner of the number one brand in the Philippines. And with that, we produce the number one yogurt drink in the Philippines. And our shares in the yogurt drink is even more dominant, actually most dominant in all the categories that we track. Close to 90% share in the latest reading. We have recently introduced Proyo. This is a more premium probiotic yogurt drink that has been gaining a lot of share recently and has helped catapult us to nearly 90% share. We've also helped Dutch Mill introduce their cultured milk a few years ago, and we have reached about 20 share. Last year, there were supply hiccups that meant that we had supply disruption as we have this cold chain product delivered to us from Thailand. We are seeing some stability in the supply, and thus we're starting to see growth in this business. You will see that our share is now comparable to a year ago, and we project to strengthen this even further with a more stable supply. Now I'll turn it over to Mike. We'll talk about our meat alternative business.
Thank you, Jesse. So to start off with, I'd like to just give everyone a snapshot of the macro opportunity. As many of you are probably aware, meat alternatives have seen significant growth over the past 5 or 6 years. This growth was driven by a number of factors. Two major ones are a greater awareness for health and a greater awareness for sustainability. And while growth in the category slowed last year, we do believe that these two factors will drive long-term growth. This view is also shared by others. On this slide, we just show some analysis that was done by the Boston Consulting Group last year, showing various growth scenarios for the meat alternative sector. Today, meat alternatives represent around 1 to 2% of the total global market for meat. Their analysis suggests that by 2035, depending on the scenario, meat alternatives could represent anywhere from 10 to 22% of the total global market. So very significant growth potential. Now, I'd like to move on to the next slide and talk a little bit about the technology. So for meat alternatives, there's 3 major technologies that are used. The first and the most prevalent is plant-based. And this is essentially taking a feedstock such as soybeans or peas, extracting the protein, and then using this protein as a base ingredient for meat alternative products. Another technology you might have heard about is cultivated. It's also called cell-based. It's a very exciting technology. It's still probably a few years away in terms of being commercially available in terms of volume and at attractive price points. And then finally, the technology I want to focus on here today is fermentation. And fermentation is the technology that Quorn uses. And it's also the technology that many people view as the next wave of innovation in this space. And on this chart here, this table is some data to help highlight or support that observation. It shows the amount of capital being invested in each of these production methods in 2020 and 2021. And what you'll notice is plant-based is flat. It's actually declined a bit. And we've seen very significant uptick in capital going into both fermentation and cultivated. And now if you dig into the numbers a bit more, you will find that at the end of 2021, there were known to be 88 companies focused on using fermentation for producing alternative proteins. And if you look further, you'll find out that approximately 80% of these companies have been formed in the past 5 years, and in fact, 50% in the past 3 years. So there is a very significant amount of capital and company formation going on in this technology. And even though it's viewed as the next wave of innovation, it's somewhat ironic. Quorn has been doing this for decades, with its first product commercially available over 35 years ago. And ever since this time, they've been building expertise in both scaling the process and in efficiency, generating gross margins close to 40% last year. And today we have a very strong R&D team who's focused on further refining the process and enhancing the products to stay one step ahead of the competition. Now, I'd like to move on to the next slide and talk specifically about Quorn's base ingredient, which is mycoprotein. As I mentioned, this is produced using a fermentation process, and the process itself is relatively simple. A tiny speck of a naturally occurring fungi called Fusarium venenatum is placed within a very large fermenter along with glucose and some nutrients. And essentially, within a few days, in less than a week, the fermenter is producing roughly 45 metric tons of mycoprotein per day. Now, just to give you a little bit of background on some positive and unique characteristics of mycoprotein, first, it has a very neutral underlying flavor and a natural fibrosity. And this lends itself extremely well to mimicking a wide range of meats. Additionally, in terms of health, it is similar to traditional meat in that it contains all the essential amino acids. However, it is unique in that it is low in fat, it has no cholesterol, it is high in fiber. There's been a number of studies suggesting the health benefits of consuming mycoprotein, and these range from lowering blood cholesterol levels, controlling blood glucose levels, and enhancing muscle development. And then finally, in terms of sustainability, as I mentioned, this is a very efficient process. You're going from a tiny speck of naturally occurring fungi to producing 45 tons per day of a high quality protein within a week. So this uses a tiny fraction of the land and water that you would need for traditional animal protein, and also emits a tiny fraction of the greenhouse gases. Now I'd like to go on to the next slide and just highlight Quorn's portfolio. So for Quorn, we talk a lot about chicken, and the reason we do this is because we view the chicken analog as our core competency. However, I do want to point out that we do produce across all meat types, and in fact, close to half of our revenue do come from beef and pork analogs. Now, I'd like to move on to the next slide and talk about Quorn's market leadership. Quorn is sold globally. However, its home market is the UK, and in the UK, it is a market leader with #1 market share. It also has a very strong brand recognition, and its customers include some of the largest retailers, including Tesco, which is the largest retailer in the UK. And Tesco has previously announced their intention to grow the alternative meat category threefold in the next 5 years. So we view this as both very positive for the space, as well as very positive for Quorn. Now, I'd like to move on to the next slide and just quickly highlight our new product development. We view this as very important to maintaining our market leadership. And on this front, we've made great success last year. In the UK, 4 of the top 10 new meat alternative products came from Quorn. Also in the US, we were very successful with a number of launches, and we were in fact voted Product of the Year by Kantar in the meatless and plant-based category. And then finally, in the QSR space, we were very pleased to have been recognized by KFC and awarded their NPD Supplier of the Year. Now, I'd like to proceed to my final slide and just highlight briefly the 3 major growth strategies for Quorn. The first, as I mentioned earlier, we are market leaders in the UK, and we want to maintain this position and even grow our market share there. So we will have a lot of focus in the UK. Our second major strategy involves the US. We've been in the US for a number of years now. However, traditionally, we've treated the US market as an export market. This changed last year. We put a lot more focus and attention onto the US market. We put in place on the ground in the US a very senior management team. We also engaged a very well-known brand ambassador to help drive brand awareness. And we opened a test kitchen innovation center to help create new products tailoring to the American palate. And then our final key strategy is the QSR and food service channel. Historically, this channel has been a very small percentage of our revenues, less than 10%. However, we view there to be many great opportunities to grow this channel. And in fact, over the past several quarters, we have seen very significant growth here. And our revenues are now approaching 15% coming from food service. Not only will food service drive growth in the UK and the US, but it will also help us drive growth globally, both into markets we're currently in, as well as to expanding into new markets. So this is a very key strategy going forward. And with that, this concludes the formal part of the presentation, and I'd like to now turn it back over to Tamara for questions. Thank you.
Thank you, Mike. Thank you, Jesse. So we have some time for a little bit of Q&A. I thought that was very interesting, and you alluded to supply chains. And one thing here I get, there's a lot of interest from our clients about supply chains and just getting a feel from the ground what that is really meaning. So if you could just speak more about the supply chains, were you seeing these difficulties clear, and now are you starting to see more because of China's lockdowns, or are you affected by that at all?
Yeah. So, Tamara, let me answer that question. In APAC branded food and beverage, our two main ingredients are wheat and palm oil. Now, wheat, obviously, in the war in Ukraine has affected the global supply of wheat. I think that region produces nearly 30% of the wheat of the world. But we source our wheat from North America, so we are unaffected. But obviously, it has a knock-on effect on price. The price of wheat has gone up significantly. We have been able to secure our supply until the end of Q3 with much cheaper prices than spot, but they are much higher than a year ago because of the global trends. On palm oil, this is mostly sourced. I think 80% of the palm oil production in the world is from Indonesia and Malaysia. They're sourced from Southeast Asia, our neighbors. So the supply disruption is not as bad, though because of escalating prices of agri commodities, I think all the and crude oil prices as well. I think palm oil has gone up in prices as well. I mentioned earlier that palm oil is at record prices these days, and it's not helping also as Indonesia recently announced an export ban on its palm oil. Indonesia being the largest exporter of palm oil, that creates a very difficult situation on the global supply of palm oil. Fortunately, I think there has been some softening of the stance. We're still awaiting what that softening of the stance will mean. For us, we have secured supply until Q3 as well for palm oil in some parts of Q4. And we have gotten assurance from the local traders where we buy our palm oil from, that these supply contracts that we already have locked in will be honored. So far so good at this point, but we're waiting and seeing, and we need to be agile in order for us to be able to operate flawlessly during these very turbulent times. For our meat alternative business, we have forward purchase contracts for almost 6 months for a lot of our commodities. Our key commodity is glucose, sourced from wheat. So there is some disruption there. Because of the situation, we have increased our number of suppliers for glucose from 3 to 2, and 2 of those 3 are UK based. So it is nearer to where we are producing our meat alternative products. On the oil front, we used to use a lot of sunflower oil, and this is very much Ukraine dependent because the supply there has gone to almost zero. We have switched to rapeseed oil, and we are also trying to increase the physical inventory that we carry in our plant, because while we have contracts, physical contracts, it is not as secure as having physical stocks. So to the extent possible, when the expiry of those raw materials warrant, we prefer to have them in stock in our warehouses or silos, because that makes for a more resilient operation.
Very interesting. I was just wondering, so do you normally secure your supplies 6 months ahead, or are you trying to lock in?
We
Okay.
really have to adjust at this point. So that's why under this environment, cash is king, and we have abundant supply of cash. So we have just done our fundraising. We raised capital with our IPO last June 2021, and some of the cash which was meant for a 3-year capex plan, we still have. So we have over 13.5 billion in cash, and this serves us well. As we have to increase, we probably have to ensure timely payment of suppliers so they don't have a payment reason to not to supply us, and we have to increase inventory. This is very important during these turbulent times, and this is a distinct advantage that we feel we have.
Interesting. I don't know if you heard, we've got some, not just export bans in palm oil, but Malaysia just recently announced an export ban in chicken. So I would imagine, well, how do you see that that kind of behavior or policies as
obviously,
affecting demand?
Governments are trying to protect their citizens from inflation. I think in this, the environment, the inflationary environment is global, and governments are doing what they can to protect their citizens. In the end, it could worsen because we heard, for instance, that in the case of the palm oil ban in Indonesia, that there were a lot of stockpiles of palm oil that were not being sold because of the ban. So they have to eventually, they probably soften the stance. We are still, as I said, waiting for the actual guidelines of what they will come up with, probably some quota. But governments will have knee-jerk reactions, as Indonesia did with palm oil, as Malaysia did with chickens. But they will eventually, hopefully, rational heads will take over later on, and they will adjust these policies to not only supply their own citizens, but also supply the global requirements for these precious commodities.
Absolutely. Thank you very much. And thank you all at Monde Nissin. Now it's time for us to check back to our expo, look at the listed companies booths as we go on a 10-minute break. And so after 10 minutes, please come back to the main stage as we welcome the next company, which is Max's